All right, I'm live here. Welcome to the strategy room. Welcome to the banker next door. I am your host, Dr. Joe Berkowitz. This is my first ever live stream here on YouTube. We're going to see how this goes. Hopefully, I don't mess this up. But I just want to thank everybody for coming out. So this is a special show. This is a 1 year anniversary show of me having this podcast, having this channel on YouTube, and it's been really awesome. And I thank everybody for just being on here. It's been a really cool adventure so far, and I can't wait to continue rolling this along over the next year or so. So. I just did a couple of live streams for the podcast audience on the what I'm using. I used Podbean to basically push out the stream to everybody on the podcast arena. So I did last week. I did an episode where I just kind of talked about my background a little bit. I talked about the reasons that I got into this, like why I started doing the podcast, and then I talked a little bit about what's to come, hopefully into the future. So I thought I would get into that a little bit. And my plan for this live stream is to basically go about an hour. Hopefully some people will chime in. I'll get some questions here as we go along. But then basically just to get into like I usually do the weekly banking update is kind of the main show on the channel, which I usually try to put out every Sunday. So I'm not going to have the weekly banking update this week because I'm basically going to do that here today. Like I'm going to cover a bunch of the banking news for the week, try to get into some of the topics, and hopefully there'll be some questions on some of these topics. But then I'm going to try to round out the hour here by getting into a bunch of the episodes and things that I have planned for the next couple of weeks, and just talk about some of the things that are hopefully to come. So just real quickly on my background. So for anybody who doesn't know, I've been in banking for 24 years. I started out my career working for a bank called Commerce Bank, which is now TD Bank. And I started out basically working for them when I was in college, and then went to work for them full time after I graduated, and kind of right into the dot-com bubble bursting, and kind of fell into banking in a very real way. Like I didn't that really wasn't my expectation. I was really looking more to go into kind of the investment side of the business, but then fell into the banking side of it, and it's been great. I mean, I kind of fell in love with banking. I fell in love with the business of banking, particularly commercial banking. I mean, there's so many great things there in terms of all the different product lines, whether it be residential mortgages, consumer loans, commercial loans, how a bank operates. In terms of like managing their balance sheet, setting the strategy for the company, how they go about executing that strategy, the different things that they need to do. I think a lot of people look at a bank as if like I think a lot of consumers look at banks like, well, a bank is a bank is a bank, and that's just not true. Like there are many different banks that on the outside may appear identical, but I can assure you inside they're very, very, very different. There are some banks that are just commercial banks and they just want to do commercial business. There are other banks that are basically just residential mortgage shops and all they do is residential mortgages. There are other banks that want to get into more, they do a lot more specialty type of, they want to do a lot of SBA lending, what's called asset-based lending, perhaps middle market lending, things of that nature. So, there's many different flavors of banks out there. If you're like, think about Texas, for example, right? Like if you're in Texas, you might be financing a lot of like oil wells and things like that. If you're up in North Dakota or South Dakota, you might be financing a lot of fracking operations. So different banks in different parts of the country get into very different things, and that's kind of like why I just really love the business and find it so fascinating and so interesting. So as I basically progressed through my career, I eventually got into a point where I worked for a startup bank. And that was an amazing career, basically experience, career opportunity. And I spent 7 years working for, a startup bank that literally started from scratch, started from nothing, built itself up to about 150 million in assets. And at that point, some things kind of changed in my life. I decided that I needed to go in a different direction, and have ended up basically just working at a community bank, which I've been working at for a number of years now. But in that time, I also spent a year working at Citibank, one of the big four banks. Not the best year of my career. Not the uh, um, more from an experience perspective, but I'll leave it at that. So I've worked at various different size banks. I mean, I've worked at the biggest of the big. I've worked at literally a pure startup bank, with 10 people, growing to about a 50 employees. I've worked at what you would consider like a super regional bank. And then I've worked at just your typical community bank that has, that could have, 7 branches, 10 branches, 15 branches, and just works in a very specific area of a specific county and a state, that kind of thing. So that's and just very quickly, like some of the different things that I've done or experienced throughout my career. So I've have a lot of background in like credit analysis, sales, marketing, product development, portfolio management, balance sheet management, project management, risk analysis, strategic planning, digital transformation, BPM, business process management, business intelligence, and loan automation. So um, and then as far as education wise, 2001, I graduated with an undergraduate degree. Got my undergrad degree in finance with a minor in economics. Then I went on to basically go to the Stonier Graduate School of Banking, which is one of the best banking schools in the country. If not, well, I'm very biased. I think it's the best banking school because I'm also a teacher there. But then after that, went on to get my MBA. Went on to get a doctorate from the University of Wilmington in Delaware. But I am absolutely what you would call a product of the tri-state area. So for anybody who's familiar with kind of the PA, South Jersey, Delaware market, we call that the tri-state area. I am absolutely a product of the tri-state area. I went to St. Joe's undergrad, got my MBA at Widener, and did my doctorate at Wilmington University, which is all again found in the tri-state area. So, so definitely a product of that area of the country. Um, so, and again, just kind of why did I start this podcast? Well, I started because I just have a love for finance. I have a love of banking, of economics, of technology. And I wanted to try to present that in a positive light. I wanted to be an advocate for community banks. And I was hoping to create something that experienced professionals would find enjoyment in, but that also if you were a high school or a college person and you just wanted to learn more about banking and the world of finance, that you could kind of tune into these episodes and just learn, kind of what's going on in the industry, what's big in the industry, what kind of regulation is going out there. Just hopefully a lot of interesting things there. So that's it. So let me go into real quickly. I just want to go into some of the more recent podcast episodes that I just did. So I just did on Friday night yesterday. I premiered an episode of which is called "How to Handle a Superstar Employee." So, and I thought that was just a great topic, just because it brought in so many different aspects to that. In terms of you've got a superstar employee, and how do you manage that individual? If that individual has a large ego, you can be described as like a prima donna. Like what do you do with that? How do you handle that? So and there's a lot of different things that you can bring into that, as far as like you can relate that to sports, like managing a professional sports team. I used a couple of sports examples, different coaches, different teams over the decades. I also used a wrestling example with something that happened with a wrestler named the Ultimate Warrior from many years ago, where he basically held up his boss for $500,000. Like he wouldn't go out and perform unless he got paid. And of course, the boss did pay him, but then he also fired him the minute he was done. So just like interesting story, and like how do you deal with the high talented individuals that you depend on for really driving the sales and driving the growth of your business. So interesting stuff. So some of the other episodes, I talked about the Japan meltdown from the stock market, which just happened this last week. Talked about the jobs report for July of 2024. I did a book review on a book called The War on Cash. Did a documentary review for a Netflix documentary called How to Rob a Bank, which was pretty interesting. How does generative AI? What does generative AI mean for banks? How are things going in private equity? Have all the buyers in banking disappeared? And that gets into like M&A market. Why are banks struggling to find compliance officers? I talked about the Synapse failure, ultimately the Synapse bankruptcy, which is a huge topic in banking right now because it gets into something called the BaaS, banking as a service model, and working with fintechs, partnering with fintechs, hiring fintechs as vendors, like that whole uh, just that whole dynamic has really been called into question at the moment. And there's just a lot of talk around that right now in terms of things going on. I can share some stuff with you guys more with that in a few minutes. So talked about the CrowdStrike cybersecurity debacle. I had an interview with Chad Hall, who's an investment banker with Janney Montgomery Scott. We did a mid-year economic outlook. I did an episode on the new Pays digital wallet, and shout out to one of the listeners sent me a notice and basically said that yeah, it's not Paz, it's pronounced Pays, and so I thanked them for pointing that out for me so that I could correctly pronounce it in this episode here, this live stream here today. Okay, I talked about how to survive a wiperware cyber attack. Very interesting. Got into 40 banks in China just disappeared overnight, just completely disappeared. Why are banks dumping their insurance units? The Fed now is turning 1 year old. How is it going? And then I talked about banks still relying on high rate CDs to bring in deposits and to basically fund their loans. And so we've gone from a low cost funding environment to somewhat high cost funding environment. So, so it was a good discussion, but a lot, and that's just, and all those episodes just came out in the last 3 weeks. So, so that's a lot of stuff to hit on, but I've hit on a lot in the last, this last year. And so let's go over real quick. I just want to hit on some of the things that, all right, some of the things here that I've touched on other than what I just talked about. So I did loan works outs, loan participations, unrealized losses in bank bond portfolios, commercial real estate, bank mergers and acquisitions, credit unions buying banks, credit card and auto loans, personal financial statements, BRICS, technology, bank fraud, interest rates, yield curve, commercial lending, inflation, open banking, beneficial ownership information, treasury funding, change in control agreements, and on it goes from there. So what are some of the other things that I brought on and I've put onto the content on the channel? Well, I've got book reviews because I read a lot, and a lot of that reading is essential for doing this, trying to bring everybody topics that are really good that I think people will find very interesting and informative. So I've done book reviews on here. I've also done business movie and business documentary reviews, just from kind of like a pop culture standpoint, because I think a lot of the business movies and things that have come out reflect a lot of what's going on in the pop culture at the moment. Like I just did two of the newer movies that just came out recently. One was Dumb Money, which was the GameStop saga, which was really good. And then they also did a movie on BlackBerry, from the old BlackBerry phones. And I found both of them to be very funny, very interesting, very entertaining. So if anybody gets a chance, definitely go check those movies out, but check out my movie reviews on those things as well. I try to do a lot of interviews. I've interviewed some of the people I've interviewed Robert White, who is the CEO of First Colonial Bank, Bob Newman, who is with Chatham Financial. Bob basically deals with derivatives. He helps hundreds of banks across the country deal with their derivatives contracts and things of that nature. Kent Kirby from Abrigo, who's a great company. Abrigo provides a lot of loan automation type software for banks all over the country. Omar Jordan, who's CEO of Coviance. Coviance, they provide an automated loan system for home equity loans for credit unions. So very, very interesting business and what they do. I had mentioned Chad Hall earlier, the investment banker with Janney Montgomery Scott. Owen LaFave, who's a market president down at the Bank of Tampa in Florida. So just to name a few, and there's a bunch more interviews out there. And then I try to get into special series. So like I did a whole series, which also was a book review, but I did a whole series on the Lords of Easy Money. And I just felt that that was one of the best books I had read in the last 10 years. And it's a book that is critical of the Federal Reserve, but it basically points out that everything the Fed has done in the last 15, 16 years, basically just transforming our economy and leading us to where we are today. And if you want to understand the economic situation and why certain things are happening the way they are, you just got to read that book. Read that book, and you will understand. You will get what is, going on in the economy. So, okay. So, enough on that just for a second here. So let's get into. All right, let me see. I just need a drink of water here real quick. I'm not used to doing this live stuff. This is new experience here. All right. Let's switch gears and let's do what I normally do for the weekly banking update. Let's talk about some economic numbers, and let's talk about some other news stories right now. So what do we got? What do we got coming up this week as far as economic indicators? On Monday, we got OPEC monthly report. We've got the consumer inflation expectations, and we got the federal budget balance. On Tuesday, we get the PPI, and we got the API weekly crude oil stock. On Wednesday, we get the core CPI, and we also get some more CPI information for July as well. On Thursday, we got a ton of stuff coming out. We got the continuing jobless claims, initial jobless claims. We get the export-import price index, the retail sales, Philadelphia Fed manufacturing index, industrial production, business inventories, and then finally the biggest thing, we get the Atlanta Fed GDP Now numbers. So a lot of people will be waiting and looking at that. And then on Friday, we get building permits, housing starts, and the Michigan consumer sentiment. So a lot of economic data, a lot of economic information coming out this week. And so we'll be keeping a lot, get some inflation numbers, some real estate numbers, consumer sentiment, and obviously GDP numbers. So a lot of really good stuff waiting to come out this week, which is fantastic. One thing I just wanted to say real quick. So I did an episode on the Japanese market meltdown. And one of the things that I forgot to basically point out in that episode was I wanted to talk about the Fed's response to that whole situation. So if you were watching any of like the financial channels, and even if you were maybe just paying attention online or whatever, the theme that you heard from Wall Street was basically echoed on CNBC, Bloomberg, Fox Business all day long, and that was we need emergency rate cuts. The Fed's got to step in. They got to save us here. We need emergency rate cuts. We got to have it. And I think what was very interesting and what was very telling from the Fed is that, and I'll tell you what, I was surprised and I was not surprised. I was surprised because the Fed basically did nothing. All we got on Monday was a simple comment from one of the Fed governors that basically said, "Hey, yeah, it's cool. We're monitoring it, whatever." And it was very fascinating because what I was expecting was for Jeremy Powell to come out probably around 2-3 o'clock in the afternoon toward the end of the market close, and I was expecting him to just a reassuring kind of, hey, we're not doing anything at the moment, but we're watching it, we're keeping an eye on it. If things continue to deteriorate, we'll have discussions, whatever, but right now we're not making any moves, we're just watching it, we'll see what happens, that kind of thing. But you got nothing. You got nothing at all. There was Jeremy Powell did not come out at all, did not give a press conference, didn't say anything. And now you've got, and again, Wall Street wagers on all these things. So now you've got the potential for a 50 basis point rate cut has gone up a lot higher in just the last week now. Now, a lot of people are looking at that going, could we get that 50 basis point cut there in September? I'm still saying no. I'm still thinking that we're just going to get the 25 basis point rate cut. And the reason why is because if you watch the market this week, yes, it was down a big market drop on Monday, but then throughout the rest of the week, it pretty much clawed back and got to basically a break even on the week. So not as catastrophic as maybe what it might have looked like on Monday. But there was a couple interesting things though. There was no volume on Friday, and that could attributed to a couple things. It's August, it's the summertime. A lot of Wall Street's got an old saying, "Sell in May and go away." The traders, the summertime, man, they're out doing their thing, traveling, vacation, whatever. So Fridays are usually pretty light days in terms of volume, anyway. So you got that going on, but I just wonder if you're kind of getting set up there for maybe some weaker activity in the next week or two coming in here, where again, not necessarily any kind of major collapse or correction or anything like that, but just kind of weakness, like the market just kind of like just not a whole lot of volume, low, kind of the market kind of trimming, a little bit, some small losses, that kind of thing. I just wonder if that's kind of what we're setting ourselves up here for the next couple of weeks. But anyway, like I said, I just wanted to note that was a very interesting thing from the Fed. And I pointed out in that episode the central bank cuts right now. So I'll read this to everybody again. So central banks have conducted 35 rate cuts over the last 3 months, exceeding the first quarter 2024 levels. Global central banks have been cutting interest rates at their fastest pace since the 2020 pandemic. And over the last 25 years, the most cuts that were seen since May 2020. So in other words, in the last 25 years, so you've only had 2 events in the last 25 years that garnered more rate cuts than what we've currently seen right now. And that was in 2009 during the financial crisis when we had 76 rate cuts. And then in May of 2020, at the right of the start of the pandemic, when we had 92 rate cuts. And right now, as of July 24, we're at 35 rate cuts. And so we're about halfway there to where we were at those 2 major events. So again, just something to keep an eye on. And like I said, and that's kind of what made the Japan thing so interesting, because everybody else around the world is cutting. I mean, the U.S. is standing pat at the moment, but everybody else around the world is cutting rates. And we're just kind of standing pat. But the Bank of Japan was actually increasing rates, because they actually had, up until just a few months back, they actually had negative interest rates. And they had negative interest rates for like about 10 years. And so they just came back to kind of like a break even. And now they were looking to just take it up 0.25% to get a little above, negative here into positive territory. And you saw the reaction that they've had. So again, so I think even from just a case study perspective, from an economic case study perspective, very interesting. So let me just check something real quick here. Okay. So, all right, let's get into some other news and stuff here as we continue to move along. So, Morgan Stanley, Bank of America, and other Wall Street groups are facing scrutiny from the U.S. Securities and Exchange Commission over allegations that the companies have been systematically cheating customers out of billions of dollars in interest payments, reported the Financial Times. Citing regulatory filings, the lenders are allegedly sweeping idle client cash into interest-bearing alternatives to generate income, but are offering low rates to savers, the report said. Wells Fargo and Company earlier disclosed that it's in resolution talks with the SEC regarding the same issue. So very interesting. Former President Jack Polson of failed Erickson State Bank in Nebraska was sentenced to 18 months in prison for bank fraud involving loans to a relative that led to the rural bank's collapse, American Banker reported. Millennials are driving the popularity of U.S. exchange-traded funds, the Financial Times reported, citing a survey done in April by State Street Global Advisors. About 58% of the surveyed millennials use ETFs in their portfolios versus 47% of Generation X, 37% of baby boomers, according to the report. BlackRock and NASDAQ proposed a rule change to list and trade options for the asset manager's spot Ethereum exchange-traded fund, Reuters reported. So, BlackRock really trying to push that, really trying to push the cryptocurrencies, through the exchange-traded fund vehicle. Americans are returning to home equity lines of credits or HELOCs to tap their rising equity in homes without giving up their low mortgage rates, according to the Federal Reserve Bank of New York's new quarterly report on household debt and credit. After nearly 13 years of declines, balances on HELOCs have rebounded, gaining 20% since 2021. Okay, the results of the Federal Reserve's most recent survey on bank lending were not as bad as the results in the previous quarter, but they were released amid a backdrop shift following an underwhelming jobs report, Piper Sandler analyst R. Scott Seifer said. So the Federal Reserve, every quarter, they have what's called the Senior Loan Officer Survey, where they try to get an idea of like what's going on in the economy. They try to get an idea of how banks are lending, what's their appetite for lending, how aggressive they're being, that kind of thing. So, I'm going to I will be doing an episode on that entire report. I'll do an episode on that report and get that out there to everybody, probably in the next week or so. So everybody can see. I did the report on the last, the report from last quarter, but this one's coming out. So do have more information on that. Democratic lawmakers, including Senators Catherine Cortez Masto, Elizabeth Warren, and Ron Wyden, urged the federal home loan banks in a letter to allot more profit share to affordable housing and community development programs beyond the 15% they already pledged, Bloomberg News reported. Meanwhile, Deputy Treasury Secretary Wally Adeyemo and Federal Housing Finance Agency Director Sandra Thompson, in a call, pushed Federal Home Loan Bank executives to do more to boost housing supply, according to the report. Now, I want to read everybody something else here. So, to follow up on that, banks, credit unions, and insurers are rebuffing the Federal Housing Finance Agency's inquiry into the Federal Home Loan Bank system, saying the agency has no authority to change the government-sponsored enterprise's mission, the American Banker reported. So, in other words, they are now getting pushback. So, how do I explain this to everybody in a way so Federal Home Loan Bank system is a system of banks. You can almost think of it as kind of like a mini Federal Reserve, but they are basically there. So in other words, the Fed has the discount window, which is kind of like a line of credit in a way. But only the prime lenders, which is like the top 25 banks in the country, only the prime lenders can tap that window. I mean, other banks can get access to it, but it's primarily for the prime money lenders. So if you're a smaller bank, say you're like a $6 billion bank or whatever, if you need a line of credit for your bank to run operations and things like that, because remember, a bank at the end of the day is a business like anybody else, right? Like, if a business needs a line of credit to manage cash flow in terms of even out their payroll, pay for certain things that are coming up, certain things like that, banks have to do the same exact thing. But a lot of times these smaller banks, they will go to the Federal Home Loan Bank that is in their area. For Pennsylvania, the closest Federal Home Loan Bank is the branch that's located in Pittsburgh. So, and Pittsburgh basically, services a lot of banks in like Ohio, West Virginia, Virginia, PA, that kind of thing. So they go to the Federal Home Loan Bank to get a line of credit. Now, part of the Federal Home Loans Bank's mission is to basically help with housing. It's basically to push housing, try to help people achieve housing, so on and so forth. The Democratic lawmakers here, though, they want that to become the primary. They want that to become the primary thing for the Federal Home Bank system. Basically, just spend all their time, all their money, all their effort just pushing affordable housing. And that's just not, like that has, like I said, it's always been a part of what they've done, but it's never been the full mission of what they've done. I mean, the Federal Home Loan Bank does a lot of other things. And this is a Federal Home Loan Bank system is a system that has been in place for 70 years, 80 years, something like that. But it's been there a long time and it has worked extremely well. And they service, thousands of banks, 4,000 some odd banks across the country depend on the Federal Home Loan Banking system. And I just think it's a real, I don't agree with this. I think it's a real bad idea to mess with the Federal Home Banking system because I think you're messing with fire because you're messing with the system itself at that point. And I just think it's a really bad thing. I think it's really misguided. I think that if they want to do something with affordable housing, or if they want to push that in some way, I think there's a lot of ways they could do that. It just shouldn't be through the federal home loan banking system. I'm not getting that one. So anyway, okay, I will get off that soapbox on that right now. So, okay, let's get on to some other stuff here. So, JP Morgan Chase and Company Chairman and CEO Jamie Dimon said the next U.S. president should include people from the business community in the cabinet. The private sector has huge wells of expertise and produces 85% of our nation's jobs. It should have a seat at the table, Dimon wrote in an opinion piece published in the Washington Post. Yes, no doubt. I would say, Jamie really wants to be the head of the Treasury, and I think he's doing a great job of promoting himself for that job. Not that he would be bad at that job. I have a lot of respect for Jamie Dimon. I think that he's done an amazing job at JP Morgan. The guy's had a legendary career. He's a guy that we'll be reading about Jamie Dimon in history books years from now, and when people write about banking and people that were just eminent players in this era in banking, Jamie Dimon's always going to be at the top of that list. And so he's an important dude, and he's done a lot in his career. I have a lot of respect for him. So I think that if he wanted to do that, I don't think he would be a bad choice. But like I said, anyway. Berkshire Hathaway offloaded more of its shares in Bank of America, selling a total of $3.85 billion worth of Bank of America shares since July 17th, according to regulatory filings. Investor Warren Buffett's conglomerate most recently sold 19.2 million Bank of America shares for $778 million from July 30th to August 1st. Berkshire remains Bank of America's largest shareholder with a 12% stake valued at $35 million, according to S&P Global Market Intelligence data. Now, here's a really interesting thing here with Warren. So he dumped a ton of his Bank of America shares. He also dumped a ton of shares in Apple stock last week, and he's sitting on this giant stockpile of cash right now. I think he's sitting on almost like $300 billion in cash. But here's a more interesting thing. Berkshire Hathaway now owns more treasuries than the Federal Reserve. Let me say that again. Berkshire Hathaway owns more treasuries than the Federal Reserve. And I find that very interesting and very telling. So in other words, Warren sees a couple things coming here. He sees either a market crash or a major market correction, meaning a 20%, 30% correction in the market coming. Because Warren is what you call, he's a value investor. He likes to buy stuff on the cheap. He wants to buy low and sell high. That's his game. That's always been his game. He learned from the best. Benjamin was it Dodd and Benjamin Dodd, Franklin. I got the Benjamin Graham. I'm sorry, Benjamin Graham. Getting the names mixed up there. So, but he learned from the best, and that's what he is. He's a value investor. So he is building up that war chest of cash because he sees trouble on the horizon. He wants to have cash sitting there to basically buy things up on the cheap, and that's what he's doing. But the interesting thing with the treasuries is what that tells me from a portfolio perspective is that he is not concerned with his return. He's concerned with capital preservation. He wants to make sure that when stuff goes bad, that if it like he's hedging his bet. So he wants to make sure that if stuff goes really bad, that because he's got those treasuries, he's able to preserve X amount of his portfolio. Because who's got the bag? The treasuries are backed by the United States government. They're not going to default on that. Kind of interesting to think he may get his money. It may be worthless, but he may get it. This kind of interesting talk there. So, but anyway. So just some interesting notes there on Warren. So, okay, what else we got here? How are we doing on time? We're doing okay on time. So cryptocurrency, Genesis Holding completed its bankruptcy restructuring and began distributing to creditors about $4 billion in digital assets and cash. Bloomberg News reported Bitcoin creditors will receive 51% recoveries as valued on an in-kind basis, and Ether creditors will get 65% recoveries, and Solana creditors, meanwhile, will get 29% recoveries. So, and a shameless plug on my crypto series. If you go look at that, I talk about the origins of crypto. I talk about the 2022 collapse in the crypto market, which started with Terra USD, the stablecoin, and basically culminated in the collapse of FTX in November of 2022. And Genesis Global played they played a part in that whole thing with their failure, along with a number of other firms in the crypto market. So if you want more information on that, definitely go check out some of the episodes I did in my crypto series. Morgan Stanley is allowing its financial advisors to sell spot Bitcoin exchange traded funds to eligible wealthy clients as soon as this week. Bloomberg News reported, citing an unnamed source. The company told it's about 15,000 advisors to offer BlackRock Inc.'s iShare Bitcoin Trust or Fidelity Wise Origin Bitcoin Fund. So there we go. As I said a few minutes ago, there's BlackRock again trying to push this through. Now trying to push it through Morgan Stanley. Banks want more financial technology firms to be regulated under the proposed data access or open banking rule of the Consumer Financial Protection Bureau, American Banker reported. The CFPB has received over 11,000 comment letters on the proposed rule, which is expected to be finalized in October. In addition, the CFPB joined several other federal financial regulatory authorities in announcing a proposed rule to establish data standards for certain information collections submitted to financial regulatory agencies to promote interoperability of the data. So, couple of things there with that. So, because you have two sides of this, you've got open banking, and then you also have this whole issue that I talked about earlier with like the Synapse bankruptcy and the BaaS, banking as a service model, and how that has really come under a microscope by the federal regulators. And they're really starting to question, how do you evaluate, how do you determine how strong a fintech partner is, and what do you need to do to make, like, in other words, if that fintech partner fails, like Synapse failed and filed for bankruptcy and left Evolve Bank and Trust holding a bag of what do you do in that scenario? What do you do? How do you figure that out? How do you manage against that? So and so that's really come under a lot of scrutiny here. And part of the, I guess, answer in the banking community is, well, if these fintechs were more heavily regulated closer to the bank, that the way that banks are regulated, that would make it easier for banks to, continue partnering and hiring them as vendors and things of that nature. So maybe so, maybe not. But then you've also got this whole open banking aspect of this whole thing. I am not a fan of open banking, and I think that the trouble here is that most people don't know what open banking is. They don't understand what the term is. Most people, I would say it this way, most people in banking don't know what open banking is and don't understand what open banking is. So there's a lot there to unpack with that. And I would tell everybody to go back and go look up the episode I did on open banking to get the full explanation on that, because I think it's really valuable information. Now, when you're going to hear about this a lot more, it's going to come out a lot more, I would say, in the media in the next year. There's going to start to be this big push for open banking, and you're going to hear about this. And basically what open banking is so that big companies like PayPal, Google, Amazon, Microsoft, Apple, they can all, what they want to do is they all want to be able to basically hook up through an API to the bank's servers and basically be able to siphon out all of your information from the banks so that they can then, use that data and information to try to sell you a whole bunch of stuff. And basically, and they're trying to spin this as, oh, well, this will be great because this will give you more control over your data. You'll be able to manage your data, and it's great for privacy protection. I think it is potentially the greatest cybersecurity nightmare waiting to happen, because any cybersecurity professional will tell you that APIs are not secure. APIs can get hacked, and then and my gosh, I mean, I can't imagine the first bank that would do this. They get hacked, all of their customers' data is out all over the place. It's like it could just be a colossal nightmare. And I just, and again, but they're going to paint this picture of like, oh, well, this is for the consumer. This is great because you'll make it easy for you to switch banks and you control all your data and this and everything. Like, no, do not fall for that line. That is nonsense. This is all this is going to do is going to allow for these mega companies, the Magnificent Seven, to get their hands on your data, and it's their fever wet dream is to get their hands on all your data. So, so just again, something to think about there with that. So, okay. The U.S. Small Business Administration is hoping its newly launched 3-year working capital pilot program will revitalize the working capital segment of its flagship 7(a) loan guarantee program, with the agency admitted did not work well for lenders. American Banker reported, citing SBA Administrator Isabel Caselas Guzman in a press release. So I will have more information coming on that very soon. I'll be doing an episode updating on SBA and what's going on with that. Here's something that I really wanted to get into. The Charles Schwab and Fidelity Investments reported outages during the stock market sell-off August 5th, with firms resolving the technology issue by early afternoon, Bloomberg News reported, citing Schwab's post on social media platform X and the website Down Detector. So this was a major issue on Monday, and this really got me thinking. So I had mentioned earlier how I did the movie review on the movie Dumb Money, and I got into talking about the whole GameStop saga and what had happened, how that whole thing had unfolded. And one of the major players in that whole thing was Robinhood, the Robinhood app. And the Robinhood is a trading app. A lot of people, very popular, definitely amongst millennial, Gen Z generation. And what happened during that moment was Robinhood basically turned off the ability of their customers to trade GameStop, the stock itself. So the stock was plunging and they were not able to sell out of it. And basically by the time their thing was unlocked by Robinhood and they were able to go back in, they basically got shafted. And this was a huge thing. And the CEOs of Robinhood got brought up on Capitol Hill and they got grilled for a couple hours, but then that was it. And then we come to find out later on that it was Citadel, who is Robinhood's big customer. It was Citadel that basically ordered Robinhood to basically, hey, stop your customers from being able to trade the stock because we're getting crushed and we're trying to get out of this thing. So, and Robinhood dutifully followed through. And I would point out to people that the reason why you were able to trade free on Robinhood is because they sell all of your trading data to Citadel. That's how they make their money. The Citadel is their customer. You are not their customer. Citadel is their customer. So after that whole thing, and I still trying to understand how Robinhood and Citadel got away with doing that. Why was there not an investigation by the DOJ? Why did the DOJ not pry into that and find out what was exactly had transpired there? Why did the CFPB not look into that? I mean, they're supposed to be the Consumer Financial Protection Bureau, right? But going back to Monday, you had like every platform, Charles Schwab, Fidelity, Robinhood, Vanguard, like all of these, every trading platform was down for probably at least 2 hours on Monday. And it could have been a coincidence, but I don't believe in coincidence. And I just ask myself, like, is this going to be the trend now? Like, is this what we're going to see every time we have a market correction or there's some kind of panic or something going on in the market, that magically, mysteriously, all these platforms for the consumer, for the retail investor, are just going to go down and they're not going to be able to make their trades? Because you got to ask yourself, like, were the big boys on Wall Street that are sitting there with their Bloomberg terminals, were they able to make their trades? Yeah, I'm sure they were. And so I hope the DOJ looks into this. I hope they open up an investigation and again, I hope that I'm wrong. I hope that they prove me wrong. I hope they do an investigation and say, you know what, there was nothing there. It was literally it just happened that way. Okay, whatever. But like I said, I think they're just very interesting questions to point out, and time will tell what we see have happened there. So, okay. I want to get into I want to talk about a couple other things here, getting a couple of those things. So just read you off some other things happening. So ICBA rejects CFPB mischaracterization of mortgage junk fees. I'll be talking a little bit more about that in a later episode. Okay, so here we go. Some economic data, some stuff that came out last week. So factory orders dropped in June. So new orders for manufactured goods decreased 3.3% in June, following a 0.5% decline in May, the Commerce Department reported. Orders for manufactured durable goods fell 6.7% after 4 straight months of increase. Service sector index increases in July. Economic activity in the service sector increased in July after decreasing in June, according to the Institute for Supply Management. ISM's index registered 51% in July, up 2.6% from June. Housing debt increased in the second quarter. The Federal Reserve Bank of New York reported that total household debt increased by 0.6% to $17.8 trillion. Here, I got something else for you guys. Okay, here we go. Let's read this for a second. So the U.S. now has a record $17.8 trillion in household debt. We have $12.5 trillion in mortgage debt, $1.6 trillion in auto loans, $1.6 trillion in student loans, and $1.1 trillion in credit card debt. Total household debt is now up 53% over the last 10 years, and total credit card debt is up 50% since 2020. Meanwhile, delinquency rates on credit cards and auto loans are nearing the highs seen in 2008. Basically, consumers are fighting inflation with debt. That is absolutely the truth right there. So more information on that to come. Consumer credit rises 2.4% in June. So consumer credit increased 2.4% in June after rising 2.7% in May. The Federal Reserve reported revolving credit, which includes credit card spending, increased at an annual rate of 1.2%. Non-revolving credit, such as auto and student loans, increased 2.9%. Let's see, do I got anything else? No, okay. All right, I want to get into some other stuff here. So Wall Street Journal had an interesting article that said basically a surge in commercial property foreclosures suggested that a bottom is near. And that's because they're seeing some movement now in the commercial space, particularly with office buildings basically selling at discounts and going through foreclosure process and stuff like that. I am not ready to say that. I don't necessarily agree with this. I think that there is still more to come. I mean, banks really haven't seen major delinquency yet. And I think that we need to see that. Like, we need to see a lot more happening there. When you start to see defaults in other market segments, like in apartments, in retail and industrial, when that starts happening, again, I think that will be a more telling sign for a lot of stuff. So I'm not ready to call any bottoms yet. So Wells Fargo says that the Fed risks a vicious cycle downturn without aggressive rate cuts. I think the Fed is in trouble either way. I think there are major. I've said before that I think the Fed is trying to thread the greatest needle of all time. I think there are extreme dangers either way, whether the Fed increases rates or they don't, or they decrease rates. Either way, the Fed risks major jeopardy and major calamity either way. Again, goes back to the Lords of Easy Money. If you read the Lords of Easy Money, you'll understand what I'm talking about. Okay, quick update on M&A activity. So what's going on here? So number of deals, year to date, there have been 67 mergers and acquisitions in the banking business. How does that compare to prior years? So in 2022, we had 156 deals. In 2023, we had 100. And now this year, we're at 67. So we're kind of on pace to get to about 100 deals for the year. Might go a little over, might go a little under. We'll have to see. But worth keeping an eye on. I mean, certain M&A certainly not setting the world on fire there. Let's see what else. Just tons and tons of news. So key portion of the yield curve nears inversion end with another still deep. It's kind of a weird time. Key portion of yield curve near inversion end with another still deeply negative. So in other words, translate that, the yield curve is still negative. And we still got problems there with the yield curve. Community banks' net interest margin loan growth efficiency ratios worsen year over year in the second quarter. So median trends in three metrics worsened for U.S. public banks with under $10 billion in assets, according to S&P Global Market Intelligence. The median net interest margin (NIM) fell 15 basis points to 3.12 from 3.27%. Community banks in the Northeast posted the lowest median NIM of 2.84%, while their peers in other regions kept their median net interest margin above 3%. And in all 5 U.S. regions, the median efficiency ratios for the covered community banks worsened, with the Southeast region having the worst median efficiency ratio of 70.2%. Year-over-year loan growth also slowed down for community banks across all U.S. regions, with the Southeast also posting the lowest median growth of 4.6%. So let me just talk about efficiency ratios for a minute. So where you generally want to be in the banking business in terms of efficiency ratios is you generally want to be in like a 55 to 65% range. That's kind of the sweet spot. You want to be somewhere in there. If you're at like 58, 60%, 60, that's pretty, you're doing really good. And I would say industry average right now, probably, if I had to guess, probably 62, 63%, something like that on average across all the banks in the country. But here's the thing. I want you to think about like this. Your efficiency ratio. So in other words, if you have an efficiency ratio of 70%, what that's telling you is that it takes you 70 cents to generate every dollar of revenue that you have, which means that that's profit margin, right? Your profit margin is getting squeezed. So if you've got, 55% or 60% efficiency ratio, that means it's only cost you 55 or 60 cents to make a dollar. Which is obviously good because that means the bank's got a very healthy, very strong profit margin and should be doing pretty good. So when you start to see that efficiency ratio jump up to 70%, that means the profit margin of the bank is getting squeezed and, not so good. It's not 70%, certainly not like catastrophic. I mean, there's certainly other banks around the country that operate. I mean, some banks around the country operate with probably like almost an 80% efficiency ratio, but it's, but like I said, it delves into, your profit margins and how profitable the bank is and things like that. So you always want to keep a sharp eye on efficiency ratios and kind of what's going on there. Okay. Community bank earnings tested, but not crushed by commercial real estate. Like I said, a little bit of uptick, but not horrific with the delinquency. U.S. corporate bankruptcy filings ease in July. However, they are still on pace to basically be near the 2020 highs. So a lot of bankruptcies being filed this year. So it's something to keep an eye on. U.S. banks announced 3 more sale leaseback deals in July. So one of the things I talked about in a couple of the episodes I've done on unrealized losses in banks' bond portfolios. So some of the banks that have decided to realize losses, they have to offset those losses. And how some banks have been doing that is by doing what's called a sale leaseback on, say, their branches. So in other words, you take a bank branch, you sell that to an investor who then leases it back to the bank. So as far as the customer goes, nothing has changed. Their branch is still there, still open, same people working there every day. Nothing has changed. The only difference is that the bank sold the branch so that they could put cash in their pocket to offset the loss that they just took on repositioning their bond portfolio. So, and this is kind of an interesting trend that is, kind of gaining steam across the U.S. The only problem is, now the banks don't control their real estate, which could become problematic in other ways there. So, okay. So we got a few minutes left here. What I wanted to do was I wanted to point out some of the episodes that I've got coming up over the next 2 weeks. So some of the things I'm going to be working on, Bank Director, they just issued their 2024 governance best practice survey. So I'm going to be doing an episode on that. What is happening in the labor market? I want to talk about that. Check fraud. Check fraud is still an enormous problem in banking. The FHFA's new credit scoring requirements. Everybody should want to pay attention to that, especially anybody who's out there looking for a mortgage right now. I'll do an episode on that. So the CFPB's report on credit card delinquency should be very interesting. What can banks learn from behavioral economics? A very good topic there. FDIC's proposal on broker deposits. Interesting developments with that. How could small banks level the playing field? Are banks taking enough risk? I'm going to do an update on the SBA and what's going on with their programs and different things that they're doing. How can trademarks impact banks? This was a really interesting study that just came out about how, trademarks and banks that have failed and banks with similar names and stuff like that. So interesting study that came out. I'm going to do a payments update. So in other words, I'm going to talk about payment apps, the payment ecosystem, instant payments, all that stuff kind of bottled into one episode. We're going to talk about the Chinese real estate. We're going to talk about we're going to do a mortgage market update. Banks dialing back real estate exposure, and then finally we're going to get into an episode on bank stock, just bank stocks in general. How are bank stocks performing? What's going on with them? How are things going in there? So, a lot of information there. So, so that's what I got coming up here the next couple of weeks. I would just point out to everybody next week, I will not have a banking update next week. No live streams next week. My goal is to have, I'll basically put out an episode, hopefully just about every day going through next Sunday. So we'll have new episodes this week, but I'm trying to take a week off here for the summer. So basically new content will be coming out, but there won't be I won't do a banking update, won't be a live stream next week. When I get back 2 weeks, hopefully more live streaming to come. And I just got to figure out like when is kind of the best time to do this. Like, is it Saturday afternoon? Is it Saturday night? Is it Sundays? Is it a week, one night during the week? So if anybody has any thoughts on that, please chime in, because I would love to hear people's feedback on that area. So, okay. And I want to give a shout out to my sponsor, my only sponsor for this channel and this podcast, and that is Willow Street Pictures. I really want to thank them. Those guys are awesome over there. You could check them out at www.willowstreetpictures.com. They specialize in pet photography, family pictures, and corporate headshots and other corporate photography. Great guys. Darren and Chris over there are phenomenal. Those guys have been in the business for over 20 years and just do some really good work. If anybody has gone to thebankernextdoor.com, you would see that those guys helped me out with all of the photography and pictures and everything that are on my website. Those guys did for me, and I just can't appreciate all of their help enough with that. So, and then I would also say, if anybody's got any topics that they would like to cover, or if there's any bankers out there that are listening to this that would like to get on the show, please feel free to email me at info@thebankernextdoor.com. Send me an email. Let me know if you'd be interested in coming on the show, or if, like I said, or if you have topics that you would like me to cover. Please make sure, send that out. Let me know. I'd be happy to do that, and happy to venture into some other information. So, that's all I got. I was hoping to maybe have a little bit more interaction or have some more questions here today, but that's okay. The first live stream, first one out the gate. There'll be many, many more of these to follow. I hope, like I said, this format is going to turn into what I call this show is going to be the strategy room, or just strategy room rather, BND strategy room. And like I said, I'm hoping to do this a lot more into the future. So hopefully everybody will enjoy it, create a lot more interaction with the audience and things like that. So, but with that, I will wrap it up. So I hope everybody, please make sure, like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Leave your comments down below, as I always love getting back to people. Check out thebankernextdoor.com. And like I said, I wish everybody a great week out there. Thank you for watching again this 1 year anniversary special. It has really been a journey this first year, and I can't wait. A lot of good things coming in the future, and we'll go from there. So with that, I'm going to end the stream. So everybody have a wonderful week out there, and I'll see everybody again soon. Thanks a lot.